Good afternoon and welcome everyone to today's CFO Leadership Council program, Leading the Path with SPAC. My name is Stacy Hall and I'm the California Regional Director for the CFO Leadership Council. We hope everyone is doing well and staying safe. We thank you for your continued membership and partnership. I also want to thank our co-chairs and steering committee for helping us bring these programs together. We have a couple of housekeeping things. We want to let everyone know your lines are muted to avoid distraction. However, we certainly encourage your questions and comments throughout today's discussion. So please feel free to type your questions in the question box and we'll get to them as soon as we can. If you're a member of the CFOLC, you will receive CPE credit for today's webcast, just as you would in the live event. To receive credit, you must be a current member and answer 3 of the 4 polling questions. We will interrupt the discussion today to bring those to you and give you a chance to answer. In order to answer the polling questions effectively, you must be logged in. If you've dialed in and want to receive CPE, please hang up and use the direct link provided to your registration. If you're wondering how to become a member of the CFOLC, connect with me after the webcast. We can help facilitate that. The good news, if you join today, you will qualify for today's CPE. As we do with our live events, I just want to take a moment and give a little shout out to our sponsors who make these events possible. We really choose our sponsors as thought leaders, and they're exclusive to their categories and industries, and they are such good resources and contacts for our members, along with our steering committee and our co-chairs. So I highly recommend you connect with them. Just first, I want to kick it off. I want to talk about Bank of America. CFOLC has been lucky to have Bank of America as one of our longtime sponsors. I cannot say enough good things about Chapter Representatives Cindy Harrington and Yaving Huda. Oracle NetSuite is another one of our national sponsors and perfect for all your cloud accounting solutions. Our steering committee reps are Heidi Munson and Robert Flowers, great resources for you. KPMG, whether it's figuring out the new tax changes or guiding you through an audit, KPMG can help you through it. Jules Walker is our steering committee representative, and he is a longtime supporter of CFOLC, probably one of our original sponsors. So he's amazing. So if you don't know him, you need to get connected with him. Effectus Group, for all your technical accounting and staffing needs, our longtime partners are Mike Montgomery and Matt Savetich. They are amazing resources and such a wealth of information. Mike is on our panel today, so I'm super excited about that. Nucleus provides day-to-day accounting, HR, payroll compliance, and legal services in over 50 countries. Our steering committee representative is Rohit Tarkanda. He is such an excellent resource for our members and just an all-around great guy. You need to connect with him. He's a big foodie, so ask him about that when you connect with him. Heffernan Group, there's no better time than now for CFL members to delve into risk solutions with insurance partner Heffernan. Joseph Talmadge and Mark Davidson are our steering committee representatives. You want to make sure you connect with them during this time. Profix can help you automate your FP&A processes and give you the insights you need. Jeff Wiggin is our steering committee representative, and I have to tell you, he is also a great guy and so helpful for our members. Topalti, the only global payables automation platform that scales with you. Rob Eisrich is our steering committee representative. Rob is so well connected in the community and so valuable to our membership. You will not regret connecting with him. And last but not least, Newmark, Knight and Frank, offering a range of real estate development and management services. John McKay is our steering committee representative. He put on an excellent program for us last month, so if you missed it, it's available in our portal, and I definitely recommend checking it out. So thank you to all our sponsors and our steering committee and co-chair. I highly encourage you to connect with each and every one, even though we're virtual right now. It's so important to stay connected. They're listed on our CFOLC Silicon Valley page. You can find them all there. So now with that, I'd like to turn it over to Susie Taharian. Susie is one of our co-chairs for the chapter, along with Bonnie Tomei. Susie's CFO of Brightspeed, but that is one of probably about 5 different jobs she holds. She pretty much does it all. And as the saying goes, if you want to get something done, give it to the busiest person. And I believe that would be Susie. So Susie, I will turn it over to you, but I would love if you would share a little more about your background as well.
Thank you for the introduction, Stacy, and great to see everyone. Thank you for joining us. I'm really excited about this topic. This is a really exciting and very timely topic, and I think relevant to a a lot of our members. I'll give a quick introduction of myself, and then I'll ask the panelists to introduce themselves, and then we'll kick off the topic. A little bit about my background. As Stacy mentioned, I'm currently CFO of Wrightspeed. Wrightspeed is an electric vehicle company. We make powertrains and engines to reduce emissions for commercial vehicles. And it's relevant to the SPAC topic because, as you may have been following the SPAC activity, there's been a tremendous amount of SPAC activity in the electric vehicle market. But I've also had touch points with SPAC in a couple of different ways. I'm also on the board of a New Hold Investment Corp, where Adam Dush is the CFO, and I'll let Adam talk more about that. That's a SPAC that went public earlier this year, July 31st. And I also had experience with a SPAC a few years ago when I was CFO of a company that was publicly traded through the reverse merger SPAC process and trade on the Toronto Exchange. So I've sort of seen companies before the SPAC process, after the SPAC process, and also from the SPAC perspective. So delighted to be with you today. Let me ask each of the panelists to introduce themselves, and then we'll get into the topic a little bit more. Mark, maybe we could start with you.
Sure. Thanks, Susie. I'm Mark McComb. I'm an audit partner with KPMG. I did a good job of providing a useful picture of myself here, but I specialize primarily in healthcare and life sciences companies, and one of my clients is right in the middle of a SPAC transaction right now, so that's how I got nominated to participate in the panel. So happy to be here.
Thank you, Mark. Great to have you. Mike, do you want to say a little bit about yourself as well?
Yeah, happy to. Thank you. Mike Montgomery. I'm a partner at Effectus Group. Work with many of our clients on transactions. Both IPO prep and I'll call it SPAC process. I'm not sure that there's a lot of prep that goes into a SPAC sometimes, but I'll call it SPAC transactions. And I've led many projects for our team, for our clients, and for our team. So I'm happy to be here and excited to talk about the topic.
And then Adam, if you could say something about yourself and share some background.
Thanks so much, Susie. Good evening, everyone. My name is Adam Deutsch. I'm a co-founder of New Hold Enterprises, which is a Berkshire-style industrial holding company that on one side of our portfolio is focused on long-term development of essential services platforms, specifically in industrial services. And on the other side, NHIC is an industrial technology-focused special purpose acquisition company, $172.5 million in trust. We're very fortunate to have Susie on our board of directors. And we are very fortunate to say that we're currently under LOI on a particular process right now. Very nice to be speaking with you all, and thank you very much for the invitation.
Great to have it. As you see, we have a fantastic panel with a lot of experience in this area. I should mention that two of our panelists are also very musically talented. So if we decide that we don't want to talk about this SPAC thing, we could probably do some great musical entertainment as well. But if you change your mind about the SPAC,
taking requests.
Yes. So if we could quickly, there's a slide I wanted to share just to give a little bit of backdrop on SPAC. The reason we're talking about SPACs is there's been a tremendous increase in activity in special purpose acquisition companies, or SPACs as they're known. This is an article that came out about a week ago from Financial Times. It shows SPAC activity from 2015 till today, and you can see the spike in activity in 2020. Per this article, about $51 billion were raised in SPACs this year. This is about the same amount as activities in IPO. So SPACs are now catching up with initial public offerings. And you can see on the graph on the right, the yellow columns are SPACs and the blue columns are IPOs. And you can see in 2020, the SPACs have been catching up. An interesting fact is, per Financial Times, that SPAC activity in 2020 equals to the last 9 years combined. So this is a tremendous surge in activity. So as you've probably heard, a lot of companies have done a reverse merger process to go public that way. There's a lot of SPACs that have announced that they've raised money and looking for acquisition. So a lot going on in this space, and we thought it'd be timely to talk about what SPACs are and how they might be relevant to you. So with that, we thought we'd do a quick polling question to get a sense of where the audience is and your knowledge of SPACs. So let us know, is your company in or contemplating being in a SPAC transaction? Yes, no, or currently in the middle of one, and or need to analyze further. So we'll give you about, I think it's 30 seconds to pick one of these, and then we'll see. And I give us a little bit of an idea what the audience's knowledge is before we jump in. Okay, so it sounds like about 65% of our group is not in a SPAC, but thinking about it. So only about 5% of the folks of our audience are in the SPAC transaction and have some familiarity with it. So with that, I think probably it's a great time to be with this panel, and we will ask our panelists to share some of their experience and raise our overall knowledge and understanding. So the first question we want to talk about is just to know what a SPAC process is. And I thought maybe our panelists could talk, what is a SPAC, what's a reverse merger, and walk us through the steps on what the process looks like. And maybe I could just start with Mark, and if you could just give us sort of a short walkthrough of a SPAC process.
Well, maybe what I can do is talk about it from the auditor's point of view. Adam and Mike maybe have a broader perspective, and they can chime in on that too. But from an auditor's point of view, the real challenge is, and again, speaking from the SPAC target company that would be going public through this transaction, this type of transaction, there are a couple of big challenges, but the main challenge is going from a private company to a public company set of financial statements. And I think it's pretty common for the target companies to be private companies, maybe haven't been contemplating going public as rapidly as they find themselves once the SPAC transaction takes off. And so there are a number of aspects that need to come into play in order to produce the financial information that goes into this overall filing. So the auditors typically would need to upgrade the independence analysis to get up to public company standards. They would need to upgrade the level of the audit work to meet PCAOB standards. So that means even though you may have been audited previously under AICPA private company standards, you may have to go back and choose additional samples, reduce materiality. There's a lot of scrutiny that comes into play. You may have to unwind private company accounting elections and make sure that you're public company compliant. And there's just a lot that goes into just looking at this one aspect of producing the audited financials to go into the document. It can be a tremendous amount of effort in a short period of time that places a lot of demand on you and your finance staff, and probably in all likelihood, you probably won't have the resources internally to handle everything. And that's where Mike and organizations like his come in to help supplement the company. So maybe I'll pause there and see if anybody has any questions, or maybe hand it off to Adam to maybe discuss the transaction from the top down, and then Mike from there.
Sure. Good evening, everyone. So just with respect for the poll, and in my capacity as the Chief Financial Officer of a SPAC company, to quote one of my comedic icons, Jackie Mason, it seems as if it's a tough room. Completely understood. What we at Newhold are first and foremost looking to assess is within our sector focus of industrial technology, which of course can break down into a variety of different subsectors, whether that's 8 or 16 or 35, depending on how you segment it. We're first and foremost looking at, does our SPAC present a solution for your business, right? Is there some relevance here that a conventional IPO, a direct listing, which of course is an option if you're not looking to raise capital in association with the listing or the private capital markets can't solve for. If there is not a compelling answer to that, we very nicely go pencils down, right? I'm not suggesting that as a SPAC, which is fundamentally a trust, comes up on the end of its life cycle, they may not be having some interesting conversations around trying to strike transactions just so as to get a deal done. But under an optimal set of circumstances, the special purpose acquisition company should be providing you some value. And it should be providing you some value because it has a dilutive impact on what will ultimately be public cap table of your company. In terms of what actually happens, we're in an environment right now where the SPAC is becoming a little bit more popularized. It's becoming a little bit more banked by the same, frankly, some of the bankers that had done traditional IPOs and are branching out and doing this product in a little bit more earnest. I'd say that from the SPAC company's perspective, that is that's steepening, that's lessening the learning curve of whether or not we can assess quickly whether or not the SPAC is adding some value to your business. But from a process perspective, we will learn about a business, we will engage with a company, we'll look to strike up a rapport, we'll look to understand the growth story of the company, we will put in an offer, a letter of intent, and that letter will usually contain some, to the extent that the offer is sophisticated, mutual exclusivity provisions, whether that's 30 or 45 or 60 days. Diligence will ramp up quite quickly. Whether or not you are working with a bank to begin with, to Mark and Mike's point, one of the greatest initial efforts will be on assessing the public company readiness of the underlying company. Is this a company that is ready to be a public company? I will say, just for my own editorial, and I'll shut up because I'm taking too much airtime, SPAC may or may not spend the requisite amount of time trying to discern whether or not your business should be a public company, whether or not your business will benefit from having a public mark, whether that's the right evolutionary step for your company. And there's various shareholders that, based on the way that SPAC transactions are being priced in the current environment, may have some differences of opinion. I think that the good SPAC managers, and I think that the good SPAC transactions, which will pass diligence, ultimately give rise to a merger agreement or reverse merger, which will then give rise to an S4, a proxy statement, and then the ultimate pricing. Just from a quick high-level process perspective, whether or not that company ultimately survives in the public markets, I also think is a critical point of certainly our diligence. Sorry, I'll hand that out to Mike now.
That was great, and I think there'll be some follow-up questions on that. But Mike, let us have you chime in as well before we.
Perfect. Perfect, and those are fantastic comments. I think maybe just the one thing to add is, when I think of a SPAC transaction from a process standpoint, there's usually 5 phases of the transaction itself that we sort of look at. There's the first phase, which is formation, the second, which is the IPO itself, the third is the target search or negotiations with the target, the fourth would be a shareholder vote for approval of the transaction, and then the last one is actually closing the transaction or closing the acquisition itself. In each of those steps, there's different parties involved, and some parties are involved in the entire process. But just to kind of touch on those really quick, in the formation process, there's usually a founding firm or a founder of an entity that becomes the SPAC itself, and the founder will facilitate the process, and there's shares that go to a founder. Usually it's roughly 20% of the post-close or post-IPO shares that go to a founder to essentially set up the SPAC transaction itself. In the second phase, in the IPO, the SPAC entity issues shares to the public, right? And usually institutional investors and other investors will come in and purchase those shares because they're interested in quote unquote partnering with the SPAC entity. And that's how a SPAC will raise capital. Once a SPAC raises capital, it then goes on to the third phase of looking for a target. And Adam talked about this and had great points on that, about looking for the right partner, the right company to acquire. But really, it's more about, I say, partnering than really acquiring the company itself. Finding the right company that you can work with, the right company to partner with. And there's obviously negotiations back and forth and a large search in that process. Once a target's been identified, an LOI is typically signed. And that's really sort of where Mark was talking about, where a lot of that prep comes in, where once an LOI is signed, the company is sort of, head down, preparing to file an S4. Sometimes it's quarterizing financial information. There's negotiations of a final merger agreement that happens. There's, thinking through key financial metrics that you want to present to the public, as an ongoing public company. There's a lot of work that goes into it. Usually an S4 is filed, and then SEC comments come back, comments are cleared, amendments are filed for the S4, and eventually you get to a shareholder vote that happens. Once the shareholder vote happens, the SEC will approve the transaction, and then you start trading as a public company. You're then a public company. So those are sort of the 5 phases that I look at, and it sounds, at a high level, may sound simple. Each phase is a tremendous amount of work with a lot of advisory help and lots of help, both from the SPAC side and also from the operating entity side. So that's kind of how I look at it from a like a 10,000 foot level, let's say.
Like, that was great. Actually, that was really helpful to kind of lay out the steps. I think that probably cleared up for folks how the process works. And with follow up on that, so most of the audience are folks that are heads of finance for various privately owned companies, which may be interested in finding a SPAC partner. So maybe we could kick it off with Adam, if you could tell us how companies could position themselves to be more attractive for a SPAC partner, and then we'll follow up with Mike and Mark, if we could, on what companies can do to prepare from a finance accounting perspective to be ready for the SPAC process.
Sure. So aside from public company readiness, right, are your financials being groomed so as to be formatted to those that can be ready for public audit? All SPAC shares open up at $10, right? It is a product, a vehicle for which there is a level of price certainty. That enterprise value, unlike a traditional IPO, was negotiated ahead of time. That sources and uses was negotiated ahead of time. What a business can do is ensure that there is a compelling equity story, right? There is a reason why that company is going to thrive as a public business, belongs as a public business, versus the various different alternatives to the special purpose acquisition company that would otherwise be available to that company. And there's a lot of different articulations of that. And I will say that with the proliferation of and the education around the SPAC product and the popularity of the SPAC product, there are more stories than ever, things that are to some degree straddling the lines between almost a venture capital style public market transaction. There's myriad ways of articulating a story and pricing a deal and structuring the sources and uses that result in $10 a share, which is what every SPAC opens up at, belong at 15 or 16 or 20 or 25, and those companies thrive in the public marketplace. But as various different companies across multivarious sectors are thinking through, is this the right solution for us? How are we going to thrive in the public marketplaces? How would we, and judging by the audience, this may or may not be a prominent consideration, be looking to position ourselves as a better SPAC target? The only thing that I would encourage is, what is the public equity story that you're looking to tell? If there's a compelling one, I feel quite confident that there's a SPAC manager that would be very interested in hearing that. And maybe more to the point, a variety of different investment banking teams that would be happy to shop that story around.
Now, before I ask Mike and Mark to tell us what your experience is on helping companies, what they need to do from a finance accounting perspective to be ready. Let us see if the audience thinks they're ready or not. So we have a poll question that we want to ask. Do you think a company is ready from an accounting financial perspective for a SPAC transaction? So we'll let the audience vote on that, and then Mike and Mark, you can tell them what they need to know, and they'll see if they are or not. So we'll give folks about 20 seconds to answer that. Okay. Okay, so most folks were honest, knowing that KPMG and Effectus were going to tell us all the things we need to do. Most folks said, hey, look, I don't think I'm ready. 78% said, no, don't think I'm ready from an accounting and financial perspective. 17% yes, and 6% said we're working on it. So Mark, if you could tell us, what do people need to do? What do CFOs need to work on to be ready for a SPAC transaction? Mark, go ahead and start. I'm sorry. It's not clear who to go.
Well, it's probably no different than what a company preparing for an IPO has to deal with. And so if you think about what is expected of a public company, do you have the internal resources to create MD&A on a timely basis every quarter? Do you have the internal resources to create quarterly financial statements? Are you able to identify and address complex technical accounting matters in-house? Do you have internal controls that are documented and that are strong and sort of battle tested? Do you have the ability to draft SEC style financial statements with full disclosures? These are all sort of the basics that companies are required to have in-house if they're going to become a public company, just from a finance and accounting perspective. Another one would be, do you have the internal resources to support all of the investor relations communications that are going to need to be produced? Think about, as a CFO, you're going to want to be able to get information quickly and timely for purposes of investor communications. Do you have those resources lined up separate from your controller? Because one of the things that clearly happens is, and I've kind of likened it to going from 0 to 100 miles an hour immediately. Just the demands on the team are almost overwhelming to get through a transaction like this. So those are a few things, and Mike, maybe you can just keep on rolling.
Sorry, let me take myself off mute there. I'd say probably one of the biggest disconnects that I see when we start working with a company that is engaging in this process is probably the disconnect between how they look at their business from a finance perspective and metrics and performance indicators versus how does that sort of compare to public company metrics across the market. And typically when you sort of think about that, any given industry will typically have certain metrics that are used. Some industries focus a lot on gross margin, some focus, more so on revenue, others focus more so on EBITDA or adjusted EBITDA, and it really depends on the industry and the type of business. And so what I normally see happen is, a company is approached, there's some discussions with the CFO and the CEO and the board and other management members, and then suddenly there's an LOI in place, pretty quickly. And there's diligence and a lot of other things that go on, but immediately the finance team is sort of forced into this discussion of how do we really look at this business and can we explain this business to institutional investors and analysts, right? As compared to other companies that are in our same industry. And do we have information that we can prepare readily and timely to reproduce these metrics and discuss these metrics? And do we want to present these metrics over the next 5 to 10 years to show the story of our company? So back to Mark's comment on investor relations and finance, I'd say that's probably one of the biggest disconnects that I normally see. The next one obviously is the financial reporting and accounting team. Most companies that engage in the process early on, haven't had the time to sort of plan. And we'll talk a little bit more about traditional IPO versus SPAC, but really haven't had the time to plan ahead and put the right pieces in place. Another one along the lines of what Mark mentioned is probably the less glamorous one, at least, sometimes our team will say this, but internal controls and making sure that there's enough internal controls in place to, both get management certifications for a filing, but also just to ensure that the company, is reporting correctly, right, and has, the right people in place, performing the right finance and accounting functions of a company to make that happen. So I won't touch as much on the legal side of things. I'm not a legal expert, although we do work with a significant number of attorneys, but there's also many legal aspects to that, just compliance and there's also, setting up a board, and there's a lot of things that go into that process that, really aren't thought of, and it's sort of like an IPO on steroids, if you will, going through a SPAC transaction. It's just very quick, and you have to have strong advisors in place that have gone through the process that don't take weeks to figure out answers. They just have answers because they've gone through it before. So I'll pause there. That was a lot.
One quick question was in the chat room. How large are the challenges in switching to ASC 606 that you've seen? Many private companies have not made the switch from ASC 605, and this can often be a major undertaking as well, especially if the target is trying to upgrade their audit concurrently. Any observations on this specific topic?
Mark,
I'll chime in. You should just early adopt 606 as soon as you can, just to get that over with. Because that in and of itself is an exercise. And so in the case that I mentioned earlier, we'd advised our client to just early adopt 606 from inception, and that paid off. But if you're in that situation where you're still on 605 and you think that a transaction might be looming, you should just start right away.
Yeah, I think there was a.
I was just going to
add, I think there was a 1 year deferral, Mark, if I'm not incorrect, that the FASB gave, but I think the year is basically up at this point. So if you're kind of stuck in the spot of trying to wrap up with 606 and also considering a transaction, I would say any accounting standards that haven't yet been adopted that are required from an accounting standpoint would be probably your number one priority over internal controls, over anything else, simply because if there's any outstanding standards that have to be filed as a public company where you can't get the EGC exemption, then those take precedent, just simply because that will hold up a filing.
And this seems like a good opportunity to ask, so what accounting finance challenges have you seen? And we'd love to hear some horror stories. Feel free not to name any names, but things that you've seen pop up that have perhaps derailed or jeopardized a SPAC transaction, or a particularly good success story that you'd like to share. So open it up for any of the panelists that want to talk about that.
Well, one thing I'll mention, and I touched on it earlier, but the audience may not have a deep appreciation for this, but if you've always been audited under sort of private company standards, one of the things that needs to be done is an independence analysis under public company standards. And those standards are more rigorous than the private company standards. And so in some cases, it may not be a big deal, but in other cases, it can be a very complex and time-consuming issue to go back and determine that your auditors are indeed independent under PCAOB standards. Now, the SEC and the PCAOB just granted some new relief on independent standards to simplify them within the last week or two, which is great. But for example, in our case, in this transaction that I'm working on, the requirements of the financials that needed to be filed in the S4 meant that we had to go back and audit an earlier year that had not previously been audited or examined for independence. And when we did that, we identified that we did have an independence violation under PCAOB standards that wouldn't have existed under AICPA standards. So we ended up having to go to the SEC to get them to agree that that particular technical issue did not impair our ability to exercise independent judgment on that prior year audit. which they ultimately did, but that was a time-consuming process. So anything that's new or that hasn't previously been looked at, maybe things will be fine, no issues, but there can also be things that crop up unexpectedly, and that's an example of one of many.
Mike, Adam, do you guys have any stories you'd like to share?
Yeah, I'll maybe add a couple onto that, and yeah, definitely not to talk about anything too specific, but I think two areas that oftentimes creep up on companies and executives very quickly. One is the concept of quarterization, and usually private companies don't deal with this as heavily, especially for audited financial statements. Given that most companies will file at some point during the year, they either file, a single quarter, 2 quarters, 9 months, et cetera, in addition to their annual financial statements. And a lot of private companies, when they go through an audit process, they will, sometimes record topside journal entries at the end of the year, or at different times throughout the year without consideration to sort of the timing during the year, simply because they only are required to present year-end audited financial statements. And so they, once you sort of look at that and you start to peel back the layers, most companies will find that they should have recorded, different adjustments and different entries at specific times during the year that aligned with the transaction or accrual or whatever it is, and didn't do so. So there can be a pretty significant process of going back and actually, we use the term quarterizing in the accounting world, and Mark probably has heard that too many times, and the CFOs on the call that have an accounting background have probably heard that many times as well. But quarterization is obviously a big one. I think the other one too that I see happen frequently is, cap tables are a tricky thing, and I'm sure there's probably several people that are laughing right now on the call where, I think we're always trying to get a cap table corrected at a point in time, but the timing of those corrections and also the timing of grants is equally as important, because those go into an EPS calculation as a public company, and there's a lot of scrutiny right now around that. And so making sure that, if you're working with a legal team, their objective may just be, hey, our client's asking for a cap table, let's get it corrected up to date and make sure that it's correct. But really, when you look backwards, every date that goes into that cap table matters once you become a public company. And you can't, I've seen some cases where, I heard a response from an attorney that, hey, we realized this was supposed to be granted on December 30th, but we just recorded it on January 3rd because it was only a few days, and we assumed that wouldn't have as much of an impact. I'm guessing it was probably someone junior on the team that had that response, but obviously that has a gigantic impact from a financial reporting standpoint. So I think just being cognizant that everything's under a microscope, and timing really does matter once you sort of roll into a public company reporting status.
The only thing that I would add is I will quote our CEO, Kevin Charlton, very warmly. It is a SPAC, so there's going to be a crazy curveball that ultimately takes place, and to the extent that hasn't transpired just yet, just wait for it. It just means that the crazy thing hasn't happened yet. This is a very frenetic, very unique, almost a little bit transactional nature of the product, and if you are hearing some of the frankly more sophisticated parties than myself talk about some of the things that you're not doing right now with your company. Well, of course you're not. As someone that spends most of his day in lower middle market private equity, you have a business to run. Of course you're not doing these things. And that's exactly why, within the context of a successful and efficient SPAC, it's important to stagger the work streams, but bring the right external advisors in around you who can help to effect this reverse combination quickly, bring it to market successfully, but also work with the company over the first couple of quarters, perhaps over the intermittent or permanent period, to help position it for success as a public business.
Sounds great. So it's going to be frantic, it's going to be hard work, it's going to go under a microscope, and it's going to be a curveball. I think a lot of our CFOs are saying, great, sign me up. So I think the question that's going to come up for folks is, why would they do a SPAC? And also, how does a SPAC compare to an IPO? Because it sounds like in either case, you end up being a public company and all the public company requirements that go with it. So let's take a poll from the audience and see what the audience thinks about an IPO versus private equity placement or a SPAC. And then we'll come back to our panelists and ask your opinion on the difference between them. So the question is, do you think a SPAC transaction would be preferable to an IPO or private equity placement for financing today? Yes, no, prefer an IPO or prefer a private equity placement? And we'll give about 20 seconds or so for our audience to vote on that. And then we'll come back to our panel and ask your opinion on the same question. So audience, I think we scared you a bit with all the requirements and challenges, but 47% still say SPAC sounds like it's preferable to an IPO or private placement. 12% say no. 29% say they prefer an IPO. 12% say they prefer a private equity placement. So SPACs still seem like they have a lead in this poll. And maybe we can start with you, Adam, on what you think is the advantages or disadvantages of a SPAC, and then ask Mike and Mark to chime in.
Sure. Fundamentally versus a traditional IPO, in the case of a SPAC, you are price certain. The funds are a little bit more uncertain. The sources and uses of a SPAC will usually require money in trust that is sitting in trust, some of which is redeemable. It will usually require the raising of a PIPE, a private investment in that public entity of varying size, depending on that sources and uses, depending on the valuation, depending on the equity story that's being told. Now, 90% of SPAC managers are ultimately successful at consummating a deal within the time that they have allotted to them. But in the case of an IPO, just to compare and contrast, what you are going to have is funds certain. An investment bank is going to bring this company to market, but the valuation that that company ultimately trades at can be very volatile, particularly over the first initial trading. And it's significantly less democratic in that if investment bank XYZ happens to be lead left, they are going to predominantly allocate that first book to their preferred clientele. Versus a SPAC, where in reality, I happen to be the CFO of NHIC, when we are trading, anyone with a brokerage account ultimately has access to that company, is encouraged to engage in the buying and selling of that business. Just as an intro example, I'll hand that off to the rest of the group.
Yeah, I think, and that's probably, I think Adam's point is perhaps maybe the largest or the number one reason why a SPAC is more attractive. I think maybe one that's also attractive, but to a lesser extent, is really just the timing and certainty of a window. And by a window, what I mean is that for traditional IPOs, there's a discussion of an IPO window, and it can open up, and it can be open for 12 months or 18 months when the markets are rising, equity values are increasing, and there's more certainty in the market. Maybe you're sort of at like the peak of an economic cycle, or on your way to a peak to an economic cycle, and sort of the stars, quote unquote, aligned for a company, right? And if you miss that window, it may be harder for there to be institutional investors that are attracted to a deal, et cetera. So we've worked with a lot of companies that started during that process or at some point during that window, and unfortunately their bankers just came back and said there's less interest in your transaction now. And they could have been prepping for 6 months or 12 months or 18 months to get to that point, investing in new ERPs, investing in additional resources, strengthening their accounting and finance team, hiring additional legal counsel, and sort of getting ready for that moment to happen. And then to kind of have a letdown that can literally happen within a month, 2 months, 3 months. Well, the entire average timeline for a SPAC transaction is, let's say, 3 months. So, you sort of work your way into a situation where there's investors that are interested. You sign an LOI, and really within 3 months, feasibly you could be trading. And so there's really not much of a window to sort of miss there. It's really, you know, the valuation is more certain, like Adam said, and it's more akin to a merger, I would say, almost, than an IPO. And so the transaction, you know, process goes through, and you're not really trying to run up against an IPO window and making sure that you go out during a 12-month period of time. We've had clients that have, you know, according to their bankers, missed that window a couple times in a row, and it's very disappointing. And we've helped them. You know, we've done IPO prep for the same company more than once, simply because the bankers, you know, started down the process, paused the process, and so they let their financial statements go stale. We go back, we go through the process again with them, and it can be pretty disappointing and discouraging for a company. So the SPAC transaction sort of takes that out of play altogether and really just sort of pushes the transaction through to the public markets and rewards the shareholders and the SPAC investors.
Mark, did you want to add anything to that?
Well, the only thing I'll add is, you know, maybe the flip side of that is that related to an IPO, normally companies have more time to kind of see it coming and prepare for it. And I've had many conversations in the last few months with some of my partners around the country about SPACs sort of coming into the picture very quickly for companies, and them having to react very quickly and gear up very quickly. And so, you know, it's exciting. It's a neat opportunity, but it can be super challenging to put everything in place that needs to be done over this accelerated timeline.
There was a question in the chat room that said, is it true that the valuation from a SPAC is not as good as an IPO? I was wondering for someone to address that.
That's not for the SPAC or, frankly, the investment bank underwriter to say. That's for the public markets to discern. And again, it really harkens back to what is the underlying equity story. Nikola was trading at $35 a share before they started rolling trucks downhill. If you have a great company, a great concept, a great equity story, again, these shares all open up at 10. That really implies nothing about the valuation of the business relative to a peer group. In fact, what I would say is that when a SPAC is being priced, the SPAC manager and the company, the shareholders, the CEO and the CFO should be on the exact same side of the table. You're trying to arrive at a value relative to a public comp set. You're going to take some discount, some articulable discount to that public comp set, because the shares are opening up at 10. We're not giving away all of that value in the way that a private equity firm, wouldn't try to blend average at 12 a platform if they were able to trade at 12 and a half. You're trying to get some attraction around the equity story, but there's complete alignment of incentives in terms of the opening share price and the story that's ultimately being told around that company, in a way that if you were doing, for example, an IPO or a direct listing, you absolutely do not have.
Let me follow up on that, Adam, this clarification, because I think a lot of people get puzzled by this. As you know, the SPAC raises a certain amount of money, and sometimes people call it a blank check company, which I don't like, because it's not a blank check. There's a certain mandate and guidance. But let's say the SPAC raises $200 million and goes out to do a transaction. The transaction it might do is not limited to that $200 million. That's not limiting the valuation. And you mentioned the pipe. Can you talk quickly about what the pipe is and what the value of the check or money in trust that's in the SPAC
Sure.
compared to the value of the company they buy? And clear that up for folks. I think that might be helpful.
Absolutely. Okay, so a SPAC company, NHIC, raises money in trust. We have two major categories of investors. We have anchor investors, who are putting their same money into the same trust, and we have who are gaining founder shares in our sponsor in exchange for their anchor investment. And we have ordinary institutional investors who are putting money in trust, who receive units, and those units are ultimately splittable into stock and warrants. The investors that are non-anchor investors in that trust have the right to redeem their money in advance of the filing of our S4. Once we have a merger agreement, once that is announced, the investors in our trust, it's a $172.5 million trust, that are non-anchor based do have the right to redeem their stock, and they would keep their warrants. Hence the incentive for investors to come into a SPAC where they are in essence trading among themselves $10 bills up through the point that we discern that those $10 should be traded at $13 or $14 or $15 a share. Now, separate and apart from that, while we do have $172.5 million in trust accruing interest right now, we have a deal under LOI. That has no bearing on what is the ultimate valuation of the target that we are pricing. That could be a $1.5, $2 billion enterprise value business that we're assigning the value to. In that context, our relatively small SPAC may be particularly attractive because versus a $400 or $500 million sponsor, our $172 million SPAC is less dilutive as those shares are being factored into the cumulative cap table once that company becomes public. But in addition to that, perhaps that business, perhaps your business, has a need for additional growth capital. And that would be raised in the form of a PIPE, which is completely separate from the raising of a SPAC trust, which is sitting in account. Maybe that's a $100 or $200 or $300 million PIPE that is raised in part from some of those investors that came into the trust, in part from other more traditional fundamental investors who, unlike the more hedge fund style investors who come into trust and may be looking at that as a little bit more of an arb play, maybe those folks who are hybrid structured capital, they may be hedgies, they may be more traditional private equity funds that are beginning to play in this space. And those individuals are actually looking to do some fundamental diligence on the target, on the deal that's being done. And that PIPE process, particularly as this SPAC product grows more sophisticated, serves in essence to the prior question about valuation as a real-time confirmation, piece of confirmatory diligence on the mark, on the contemplated sources and uses, and which will ultimately give the SPAC company as well as the shareholders of the target that will be reverse comboed some security that they've got the capital to close the deal, but also that they will have a real series of sophisticated investor comps that will have just come into this transaction. In many instances, in a good SPAC, you may have lead shareholders of the company come into the PIPE. You may have primary customers that are coming in and underwriting a big piece of the PIPE. And that capital, the PIPE capital, as well as the non-redeemed trust capital, is the money with which you could ultimately seek leverage as well, to the extent that it's that kind of transaction, the capital with which the deal will close. Whether or not you have shareholders that are taking any money off the table is entirely subject to the deal that's being done, the negotiation that's on the table, and back to the equity story that you are ultimately looking to tell. In a best case scenario, you have no shareholders that are taking any money off the table, and rather are anchoring the PIPE of the deal that's being done. That communicates to the entire market a tremendous amount of confidence in the deal that is ultimately being brought to the public markets. A lot of confidence in that equity story. I'm sorry to be long-winded there, but I hope that was a little helpful.
Yeah, that was great. That was really good. Thank you, Adam. What I'd like to ask is, looking at the graph that's still in front of us, we can see this huge spike in 2020. And I guess the question that comes up is, Do we see this as a continuing trend, or is 2020 a spike? So we might take a poll question, and then we'll come back to our panelists and ask your opinion on it. So we could throw the poll question up. It's in the current work environment, especially because we're a COVID remote work environment, do you think it is easier or more difficult to do a SPAC transaction? And then we'll follow up with the panelists and ask you, what do you think the future looks like for SPACs? So the question is it easier, more difficult, or about the same to do a SPAC transaction in the current current remote work environment? It's interesting because it's kind of evenly split. People are saying 38% are saying it's easier, 38% are saying it's more difficult, 25% are saying it's about the same. So let me ask our panelists, and maybe we could start with you, Mark. Do you see it as being easier, more difficult? And also just in general, what's your view and outlook on SPACs in 2021?
Well, my view is that any complex transaction is more difficult in the remote work environment world. We're all making it work, and it's remarkable that we have developed all these workarounds very quickly that allow us to complete the transaction. But when it comes down to it, it is much easier if we're able to be in rooms together and walk down the hall and talk to one another. So, so that's how I would have voted on that one, but we're getting through it. I'm probably not the right person to make a prediction on whether SPACs are here to stay. I'll leave that to Adam, but I'll keep it moving along to the other panelists.
Yeah.
Mike, Adam, what do you think?
Maybe I'll jump in, and then we'll kick this one over to Adam. Yeah, I think there's definitely, in transactions that I've worked on in the past in sort of the traditional non-shelter-in-place COVID-19 environment, it's really helpful to, let's say you're sitting at the printers, or let's say that you're sitting in a conference room with all the different advisors there discussing a transaction live. And to the extent there's some debate, there's some back and forth, it's helpful to understand the economics of a transaction, to understand different viewpoints. You can do that over a call, but it's hard. It's much harder to facilitate a very candid conversation. Likewise, in review of, let's just give an example of a merger agreement. You have different parties that are adding different comments. And so you spend a lot of time going through a lot of different people's view on a document. And then there's follow-up calls to talk about follow-up comments. And whereas if you're able to just sort of work live in a very sort of vacuum type environment, those things resolve themselves very quickly. Just because people talk live, they resolve a comment, they resolve an issue. And so kind of aligning with what Mark said, I think that's easier. I will say that for some of our teams, it has been very nice to have different teams working in sort of different silos on different things at the same time, and not having to worry so much about, like, hey, let's drive to a client site, let's sit down, let's get set up, let's wait for them to free up from their meetings, then we can meet with them on something. And I think that, both our clients and companies we work with and our teams have better aligned with this working remotely environment. And so we were already doing that to some extent with some of our clients, where we'd have a client in New York, let's say, and we may fly out to meet with them, up front for a project, and then maybe once or twice throughout. Our team was already doing that to some extent, but I think coming out of this, we'll probably kind of fall somewhere in the middle, where we'll try and take the best of what we've learned, through this process and fully implement that throughout our firm, but still make sure that we allow for like the more heavy discussion type parts of the project, which I just think are very meaningful, in person. To the prediction aspect, I'm like Mark in that I'm although I have an economics degree, I don't claim to really understand the markets as well as I probably should, but I do think that there's still a lot of, what they call dry powder on the sidelines, and a lot of institutional investors wanting to invest money. And so I think that kind of balances between public markets and private markets. And to the extent that, there's great valuations in taking a company that's on the verge of going public, or maybe there's a chance to take them public into the public markets, I think we'll continue to see this. But I think that it always kind of bounces back and forth. So, I think there's an aspect of uncertainty right now in the markets, and SPAC transactions align well with that. And maybe that's why we've kind of seen a shift from some companies that would have planned, some of our clients said, hey, late 2021, we want to do an IPO, but all of a sudden they're now in a SPAC conversation. I think it's because they're taking advantage of that and not wanting to kind of see that through the uncertainty and see what 2021 will look like. But So I think that we'll have maybe a shift back to some traditional IPOs over time, but I still think that the SPAC opportunity is there, and I think that companies have seen that it does work and that there are a lot of success stories coming out of this. Adam, I'll pass that one over to you.
Thanks, Mike. Listen, the truth of the matter is Mark and Mike are the folks that work really hard on SPAC, right? It's the advisors that allow this product to be in a lot of instances, in addition to working in very close concert with the management teams of these companies that, you know, are put through this gauntlet, on the other end of which you're a public company, you know, so congratulations, your reward for a phenomenal amount of work is a lot more work on a recurring basis. So to the extent that anyone is strongly considering this, the first thing that I would do is make sure that you're aligning yourselves with the right partners around the table. For our part, as a SPAC company, we were able to do a virtual roadshow and raise all of our money in trust without taking an actual meeting. We are doing all of our PIPE pitch meetings virtually. That is a trend that is it's efficient. You're conveying all the information. You're not traveling, you know, to the tune of several $1,000s, you know, round trip to Colorado same day for a single investor meeting. And do I see that being a trend that is likely to endure, at least in some form, in a post-COVID era? Yes, I do. You know, I think just the simple efficiency of that is so blaring that as you're looking at this even through a minimal ESG lens, that is going to be an enduring factor, to the point where you will see serial SPAC issuers, and you will see, you know, TPG doing 3 different SPAC issuances within the course of a single quarter. What does that ultimately mean? That means that there's a lot of managers, similar to any other asset class, when you're chasing a limited cohort of businesses, maybe you're expanding that cohort of businesses to earlier stage companies. Maybe some of those companies are not going to thrive as public businesses. Maybe some of those companies don't have any business as public companies. That's just not the right move for them. You're seeing, I think, a couple of earlier stage deals, particularly around a couple of sectors, some of which will be successful, others of which will not. Do I think that SPACs as a third box alternative to IPOs and direct listings are here to stay? Absolutely. Do I think that it's going to experience that kind of massive cyclicality that the IPO market does? No, I do not. And in that way, I think it will be a desirable alternative. But that is not to suggest that as we're looking at this chart below, that there is not, in some instances, some trusts that are coming up on the end of their life cycle that would very much like to get a deal done, and that will play out as you might think that it would. So I think that those SPAC managers that have industry discipline, some industry expertise, some respect and reverence that a SPAC needs to provide value in the context of the transaction in which it's being placed, I think those folks will be successful. I think in the case of like a private equity, there is a disproportionate value add that the manager can lend to the context of the deal. Of course, that pendulum can swing the other way.
Yeah, and my crystal ball is not any better than Adam's, but I do want to share one factoid that we maybe didn't touch on. As the SPACs are formed and they raise these funds, there is a time horizon for the SPAC to deploy those funds to acquire a company. Usually it's 24 months. That means that the SPAC is going to go out, and in the next 24 months, they're going to hopefully find a company that they can buy, and the company will do a reverse merger, and then that company becomes a publicly traded company. If the SPAC is not successful in finding the right acquisition target in that 24 months, they have to return those funds to the investors. As you can imagine, most SPACs would be very reluctant to return the funds and would like to deploy them and make an acquisition. So having said that, if you look at this graph and look at the funds that were raised in 2020, those are going to go out for the next 24 months. So at least through the time horizon of 2021, we should see those SPACs going out and making acquisitions. So we would see pretty significant acquisition activity with SPACs. And my personal view is that we would see a lot of new SPACs being formed as well. I'm not sure if it'll continue to the same pace that was in 2020, but we should see some more SPAC activity. So that's sort of a little bit of a view forward, and keep in mind this 24-month window and the time horizon ahead. I think we're coming up on our time. There was one question in the box that we didn't get to. Does the SPAC manager have the same market that they could reach comparing to the audience of an investment bank? Adam, do you want to comment on that?
In terms of the kind of the industry breadth?
I think the question is getting us fundraising and finding investors. So I'm not 100% clear, but
so,
it might.
You know, if anything, I'd say that a SPAC is able to draw on your more traditional institutionalized pools that would be available to an IPO. But in a lot of instances, particularly within the context of the PIPE process, you have private capital, family offices that are participating in a very active way there, in addition to more boutique and even retail investors that may be putting in, you know, $500,000, $1-2 million orders to that PIPE, depending on the transaction. So I don't want to glorify the product, you know, beyond what is appropriate, but it is definitely more democratic in terms of family office and retail investors' access to invest in this transaction from that initial $10 share place.
With that, we're coming up on our time. I would like to offer our panelists a chance to say sort of a parting word, one last thought, or a key idea that maybe you didn't get a chance to. Mark, Mike, if you want to go first, and then we'll finish off with Adam.
Yeah, Susie, I'm not sure I have much more to say. Maybe I'll just reiterate that the SPAC process can be exciting, and it can open new doors and facilitate opportunities for your company that you may not have contemplated. But the other side of it is fasten your seatbelts. So it's a ride.
Mike?
Sure, thank you. Yeah, I would say, you know, when you look across, you know, folks that have gone through this process before, you know, kind of back to the IPO discussion, you know, a lot of times companies will hire people that have gone through an IPO because they're planning on going through an IPO. In a SPAC transaction, that's not oftentimes the case. It may be, let's say that there's a director of finance, a CFO, somebody at the company that has done a great job, you know, with the private company, and now they're sort of getting nudged towards, you know, becoming a public company CFO, let's say. So whenever I meet with potential clients, and you know, they may be talking to 2 or 3 firms about coming in to help out with a project, what I'll always offer up is to share what our project plan looks like, and it really kind of showcases our ability to think ahead of what's involved in the project. And I think whether or not we get engaged, we've always gotten really good feedback that project management aspect of the process is the key between, you know, a successful transaction and one that falls apart, or at the very least one that gets delayed. And so, you know, that's probably the critical thing I would say, is that most people in the process, or a lot of people in the process, have never done it before, and so they're not even sure the right questions to ask. But just make sure to map everything out, plan ahead, project manage with the advisors that you're hiring to come in and help out, and you'll get a pretty good grasp on what needs to be done. And then from there, it's really just the right people in the right places doing the right things, you know, and just lean on your advisors to help through the process. And then there's time to sort of continue to plan ahead, you know, as a new public company, bringing in the right resources and the right personnel to help the company grow.
Adam, any final thoughts?
Thank you all for having me here this evening. You know, we opened up with a poll where, you know, I think 65% of the audience indicated that they were not, you know, strongly considering a SPAC. That's absolutely correct. But, you know, maybe that's even a little bit low. that's the accurate feedback. If you're not absolutely confident that the special purpose acquisition company is an avenue that would be additive to the next several chapters of your company's life cycle, I think that there's something that's absolutist about that. What I would say is that for the minority who are exploring further along these lines, you want to be partnering with Mark, you want to be partnering with Mike, and then ultimately you may want to invite in a SPAC partner that is looking at your company with a view to, is this going to thrive in the public marketplace? And then we'll be taking those requisite steps in order to position you to succeed along those lines. There are aspects to this product that come across a bit transactional, and there's a lot of speed in order to execute. And what I would say is that, and invariably, the SPAC manager that is bringing this all to pass may be out of your company within a 6 to 12 month period, completely absent from that cap table. And still, you are the manager, the CFO or the CEO or the COO of a company, and you're responsible, and you have fiduciary, and you have added responsibilities versus what you might have previously, and that should all be thought through. But to the extent that you do believe that your company can thrive in the public marketplace, to the extent that you'd like to list it and raise growth capital at the same time, a good SPAC transaction can present a very compelling alternative to certainly an IPO or to what the capital markets might be able to offer you in the here and the now. Thank you.
I want to thank our panelists. I really appreciate your time and insight. This was fantastic. I felt like I knew a lot about SPACs coming in, and I feel like I've learned a whole lot more. If anyone, if the members has any more questions about SPACs, feel free to reach out to the panelists. We really appreciate the members joining us for this conversation. If you have any questions about SPACs, reach out to any of the panelists. If you want someone with musical talent, go to Mike and Adam. Certainly don't come to me. Thank you very much, and I would say good night, unless, Stacy, you have anything else to say or close this out?
Sure, I'll just throw in there, I'll send an email out with some follow-up information and contact information where it's applicable. Also the recording, I know there's a lot of good information, so we'll get that out. Next month, we don't have a regular chapter meeting. We have the national conference, which is virtual, which is great for those of us on the West Coast, since usually it's in Boston. We have some great speakers lined up. Some CFO of Twitter is going to be talking. We also have the CFO of Peloton, 23andMe. So I'll send out some information on that because it's free for our premium members. And last but not least, I just want to end it with a thank you to our sponsors. And thank you so much, Susie, Mark, Mike, Adam. This was excellent. So much good information. So with that, everyone, that concludes our presentation, and I hope you have a great evening.
Thank you.
Very good.